Hey folks, welcome to the Pipnotic Symposium for the, what day is it today? The 15th of May 2023. Today we're going to talk about the supply and demand software and a bit of theory and some updates and stuff. Something that I'm really trying to do is I want to try and build out the supply and demand software. So it's a tool that can be used to do backtesting, and I don't mean automated backtesting because you don't learn anything by using automation, especially when you're trying to learn something. But you learn something when you're moving through a process slowly, because this slow progression through material has the tendency, when seen enough times, to change the beliefs of the person who's doing the work. So if you're using some automated algo, then everything is done with you. You're not seeing the evidence. You're not seeing the data. You're just showed a result. You have a hypothesis. You click on a button, and you have a graph. And you don't learn anything from that. But what you do learn something from is moving through the process manually and slowly. And it's just like anything. I mean, if you're building chairs for a living, that's what you do. You build chairs. You don't learn much about the geometry that is required in order for a chair to stand firmly on a flat surface or even an unflat surface, and how the behavior of the chair is changed when the weight of a body is on top of the chair. You don't learn anything if it's done automatically. But if you make things by hand, you put the joints together, you understand how to apply dowels and where to put glue, and how the weight of a person sitting on the chair stresses the joints of a chair. And this is a very, very profound way to learn. And so the software it's something that I use to help me change my beliefs about something. Especially if I have a hypothesis, I want to, I operate in confirmation bias mode, which is very normal, I think. I mean, you have a belief about something. You don't want your beliefs to be challenged, and so what you'll do is you'll look for data that essentially will confirm what you believe about a certain subject matter. And so the software, I've been making some changes, and the changes are essentially telling us something visually about what's going on. And I just want to show you some of these observations. I've made like an update today, and I'm going to publish that this week. I'm just doing a little bit of testing, but something that is really interesting is this whole concept of backtesting. And so before we do anything, I just want to show you a typical scenario that I'm doing. So what I'll do is don't need that anymore. And so I'll look for, I need a bunch of data. So I'll say, okay, software, show me 3,000 bars. Okay, you can do 3,000, 4,000, whatever. Don't put 100,000 because then your terminal will crash. But put something that's reasonable. 3 to 5 or 6,000. That's a lot of data. We can certainly use that to perform a study. So you put it like that. You leave it in the default configuration, and then I just want to share a hypothesis with you that I find quite fascinating. Okay, so my whole model for trading is based on what I learned a long time ago, the knowledge of which I received via two sources. First of all, I received a lot of insight based on my work with the banks, the security work with the banks. I wasn't a trader. I didn't do anything with the banks, but I worked with the banks to help them stop getting hacked. Okay, so I spent a lot of time, maybe 10 years, sitting in banks, speaking to traders and economists, but my angle has always been IT security, offensive and thus defensive IT security. But I heard a lot of really interesting things during this 10 years in the bank, speaking with people. And one of them was related to liquidity, the strength of economies relative to one another, which can be seen when you're using something like currency strength, and supply and demand, which essentially goes back to my first point, which was liquidity. And so this is where I was introduced to this whole concept. And so my search for somebody who knew something about liquidity began. So I searched and I found an individual, Chris Laurie, who many of you probably already know. And Chris took me under his wing and he taught me about this whole concept of liquidity. So I had a theoretical understanding of it via my work with the banks, and Chris had a very practical approach to understanding liquidity. And this was a really fascinating journey for me. And so, I mean, one thing that Chris did and told me, encouraged me to get comfortable with, was selling when prices are tall. Okay, so you have a something like this where price is racing north. It goes like that, and so when price is strongest, while a lot of people are are buying here, they buy. Maybe here they buy because we broke this high. They buy here, they add to their positions. I think the smarter money is looking for somewhere to sell because they're thinking we have increasing prices of an asset. Increasing prices makes for good selling opportunities, not buying opportunities. So he told me, okay, you have to get comfortable with selling when prices are high and buying when prices are low. And he had an entry that he taught me called the big stones entry. And big stones because it requires big stones, pardon the pun, to sell something that is increasing in price. But you're not randomly selling when prices are high. You need to observe the context in which this run in price is happening. Okay, and so if you see a price run like this, obviously there's going to be some structure above price that will lead one to believe that prices are going to maybe break down and continue to, rather not continue, and move lower. Okay, and this whole concept was based on one of the most fundamental things, and that is the distribution of liquidity, or these liquidity voids, as he refers to them. So you would have something like this, a pattern where prices race up like that. Okay, and what happens when price races up like that? Is this showing us strength or weakness? Well, it's actually showing us both. It's showing us that we have strength down here because prices were able to race up like that, but it's also telling us that the transition from strength into weakness is beginning. Okay, so price goes up and it goes up again, and it goes up again, and it goes up again. This is obviously unsustainable. And so when you have a very strong price move down into a structure, we can expect that prices kind of peter out because of the nature of price. If you look at an order book, we'll go here. This is the bottom of the book. I've drawn this probably several hundred times. We have the top of the book. We have bearish liquidity at the top, and the bearish liquidity decreases the lower we get. And then we have the opposite. We have bullish liquidity at the bottom of the book, and this liquidity decreases the higher we get. Essentially meaning that we have fewer buyers when prices are high and fewer sellers when prices are low. Okay, so when price is up here, we have to consider the fact that there are likely more people willing to sell at these prices than to buy. Okay, so what I want to talk about today is based on this concept, and what I've done with the software to help us create a framework around this concept is, we're drawing these little areas, and these little areas are very interesting. And there are a lot of factors that affect the way these levels are drawn. And so if we let's look at this one just here. Okay, so the software essentially is telling us that we have an area of demand here. Okay, so the software is saying if prices come back down to this area, this little box, had a solid border until this candle touched it. Okay, It says that when prices come back to this area, there is a higher probability that prices are going to move away and move higher than there is that prices are going to move through it and go lower. Okay, and so this worked out quite nicely. They don't always work like that, but the whole concept is that because prices moved away like this is an attractive price for prices to move away from in the future. Okay, but there's one thing that's super important. This pattern is complete, is created and complete dependent on the configuration of the software. And so in this configuration, I can see, due to this dot here, that this pattern was created when this candle here closed. And I know that because there's a dot above it. This is what I added today because I wanted to be able to see this. Okay, and so when this candle closed, this box was drawn on the chart telling us that prices would likely move down into and away from this box in the future. We're also told that prices moved through this. Okay, so this area of demand here was formed below this high, and the buying pressure at this area was strong enough to move prices beyond this high. Okay, so that's a pretty big deal. Okay, also notice the time of day. We are very late Asia, maybe the beginning of the European session, so there's all of a sudden an increase in buying pressure at this level. There's more liquid. This is a more liquid time of day. Okay, and so notice what happens when this pattern is formed. I mean, what happens? Did prices just continue to move higher and higher? No, they didn't. It was formed, prices went down, we went higher, and we went down, and went down again. Okay, and this is based on the concept of this liquidity distribution thing that I constantly talking about, where we have, for example, this is a very, very small price structure. Okay, it's a very small price structure, and so you would trade on this for the amount of time that's relative to the chart that you're looking at. This is not a major price structure. This is a micro price structure. So you'll hear me refer to areas of supply and demand as macro demand or micro supply, and this is dependent on the time frame that they are qualified on, because this could be a tiny little price structure that is, it could be the very, very beginning of a greater price structure. So this could be, for example, this, I'm just going to draw this like this. Let's say we have a price structure that goes like that. Okay, we go like this. Okay, so this is kind of like a turning point where price forms a base and we turn around. This structure right here could be a very, very small portion, a very tiny snippet right in here, right in there. Okay, it could be a tiny little one there. So this is the 30-minute chart. This could be a weekly chart or a daily chart, a very, very tiny one. Okay, and so what we're seeing here, we understand that we're forming a base on the greater time frame. Okay, so you take that insight, that information with you to the smaller time frame so that you have a directional bias. Okay, before we do that, I want to talk about what this means here and why this dot and this box are interesting. And the reason they are is because with a relatively high degree of probability, a high rate of probability, when a pattern like this is formed, prices will very often form the price and then begin to break down and then move back to the base, the origin of this move. This happens all the time. Okay, and so if we look at another example, here we have another one. This candle here, this dot was drawn on a chart when this candle closed, this box as well, and this line too. Okay, so it said that when this candle closes, there is a likelihood, a relative likelihood, that prices are going to move down to this area here. And the reason we think that The reason we would begin to think that this is a possibility is because if this pattern has been created, then the algo is telling us that we have had a price run higher in price that is very high relative to the time frame and the other data that we have on this chart. Okay, so it's telling us that if prices move this high this quickly, it means that this is a bit of an outlier. Okay, and so there's a pretty high probability that prices are going to move back, especially when you see this happening in an illiquid session, like for example the Asian session or out of session. Okay, and this is often happening because when you have very big price moves like this, you leave a liquidity void in the wake of the move, and a liquidity void simply means that there is an absence of liquidity. Okay, so when price runs up like that, that means there are no buyers. And so what does price have to do in order to find buyers? It must advertise cheaper prices. Okay, the market is an auction place. Okay, you have many people operating within this. We have traders, we have retail people, we have hedge funds, we have insurance companies, we have all sorts of people who are interacting with the market, and they're interacting via some kind of an intermediary, like a broker or a market maker. Okay, and so the market maker is flashing prices at us all day long. Buy, sell, bids, offers all day long. Okay, and it's up to us to make a decision to involve ourselves in the market. Okay, and so when prices run up like that, you'll often see the underlying environment change, the dynamic of the underlying market will change. And you'll often see that if price moves up like that, and we move into, let's say, an order block, or a pending order of sorts, or just a very, very thin, we reach the end of a move, then price will naturally have to move lower in order to find the bids required to continue to drive price higher. Okay, so this is very predictable behavior. Prices move up, we move back down as expected. Price accumulates at around this area here. We move up, and the whole thing happens over and over again. Okay, price moves away. The pattern would have been formed here. It wasn't formed, but I think because of configuration. Okay, price goes down a little bit more, and then we snap back and we start to move back up. We move back to the origin of the move, and this is where we move away. This one here, this candle, this dot was created when this candle closed. Okay, price tried to come back, but there was too much selling for this to be maintained. You can also see as well that we have an increase. Rather, you can see here that we formed this top here. Okay, so we have some levels here that are being challenged. Okay, so price tested many times. Okay, what is that telling us? Well, that means that the more times we dart into a level and move away from it, the lower the liquidity at that level, because each time price comes down into that level, the liquidity at that level decreases. Why? Because the orders that move down into it take it away. Okay, so we have sellers are looking to sell, and the intermediary, the broker, is buying from us. Okay, so the sell side, they buy to decrease prices, and they sell to increase prices. Okay, and so each time price comes into an area like this, the level of liquidity in that area decreases. And I've used this. I talk about pancakes a lot. Number one, I like them, but number two, it just makes perfect sense. It's a perfect metaphor for this, and that is, I mean, this is a hungry fork. He comes down, he eats that pancake. This guy comes, he eats that one, then it's gone. Okay, so that pancake at the top is gone. The next time price comes, it has to go lower. Okay, so the next pancake / pool of liquidity. Okay, when price comes down, that one's gone. So where does price have to go? It has to go deeper and deeper and deeper, and eventually there will be no more. And so prices will have to go to different order block. Okay, and this is that whole thing here where we have the buyers and we have the sellers. Okay, and so I mean this one here gets eaten, this one here gets eaten, this one here gets eaten, this one here gets eaten. So what does that mean? That means that price can easily move through those to find this one. But once it's gone there, and if this order here is big enough to consume all of this, the next time price will have to go to this one. And maybe this one here is 200,000, but the order to sell is only, this one here is only 50,000. What does that mean? Well, that means that prices won't move, and this order will consume this one. And so this one will be reduced to 150,000. Okay, so this one's now gone. Now we only have 150 available at that area. And so now we can take 3 more orders of 50,000 before this order block is removed. Okay, so let's say that now this is gone. We have another order of 50,000. This one's gone now, and it'll have to come down to this one. And this is how this whole erosion of the bottom and the top of the book happens. You have buyers consuming liquidity above price. You have sellers doing the same on the opposite side. Okay, this is how it happens. Okay, and so typically when you see prices run up like this, prices will very often move back down. It doesn't always happen. This happened in Asia. This happened during the London session, which is a much more liquid time of day. Okay, so prices went down. We came up a little bit, and then we kept going down. Okay, so there's often more liquidity during London. You can't. It's not always that clean cut, but it's often the case. Okay, here we have, this is early London. Price formed this pattern. Did it come back? It tried to, but it failed. Okay, and we have this one here. This is also London. Okay, prices came down. We held away, and then we came back. Okay, and so there is this likelihood that once this pattern is formed, the prices will often bleed back down and revisit that area, because big prices, big increases or decreases in prices are a result of thin liquidity available in that area. Okay, so if price reaches this price point here at supply, you can see that yellow line just above. This is supply. This is 30-minute supply. Let's just take a look at that. Yeah, you can see just here. Prices poked up into that area. We left a liquidity void in the wake of that move. So we can assume that this was that big 200,000 unit order. We poked into it. It consumed our 50,000 unit order. As a result, prices began to decline. Okay, same here. We moved up, early Asia. We moved back down. We have another one here just below. We move up, early Asia. Prices move back down. And so, how can this be translated into a practical backtesting framework that you could use in order to change your beliefs about what you think price is going to do? What I want you to do is I want you to use the software, set it in the configuration that I have it in. I'll show you what that looks like. It doesn't really matter. Okay, the risk reward ratio is 2. You can put 1.5 if you want. You can put 3. It doesn't matter. But you want this stretch in price to happen very quickly, and I want it to happen within one period. Okay, so we could even go 3. Okay, so we'll do that 3. So it has to be, we want price to jump up within, we want it to be 3 times the size of this area within one period. Okay, this one happened in London. Price did not come back. Okay, this one happened early London. It did not come back. This one happened early Asia. It came back. Let me just put this to a more realistic configuration. Actually, just put it 1.5 so we have more data, more examples to look at. Okay, and so what we want to do is we want to see here. Okay, here, this is the time of the day, the period separator. Price is dashed. We formed this pattern. We got the dot. prices came back to the origin. We had this one here. The dot was formed. What happened? Prices came down. 2 different days, 2 winning trades. This one here, prices came all the way back down here. Price came back to the box, winning trade. This one here, prices came back here. Price did not come back to the dot, losing trade. Another one here, did price come back? It did not, losing trade. Did price come back? It did, winning trade. Did price come back? No, I could say no, it did not, losing trade. Did price come back? It did, winning trade. Did price come back? No, losing trade. Losing trade. Did price come back? A little bit. Break even maybe. Did price come back? More or less, winning trade. Okay, and so I want you to do this, and I want you to move through different pairs on different time frames. Let's go to the minute chart now and have a look and see what that looks like. Okay, and I want you to do the same thing over and over again. Okay, let's start here. Did price come back? It did. Did price come back? It did not. Did price come back? Halfway. Did price come back? More than halfway. Did price come back? Halfway. Did price come back? No. Did price come back? It did. Did price come back? It did. No. No. Yes. Okay. And I want you to study these because they are a very it's a very good exercise to do this. And so what I'm doing now to test this hypothesis is that okay, so one of the hypotheses is that when price moves away like that, when we have an area like that is formed, there's a likelihood that prices will continue like this one. I mean, price came here, it came back, but it continued. Price here, it was formed, it went up, it came back. This one continued. And so what I want to do, what I've started doing is I've started testing the hypothesis of price moving back after an area is established. Okay, because I want to see what the likelihood is. And for about 340 trades on the 30-minute chart, I could see that trading continuations in prices moving away is a really bad idea. There was about a 60% loss on short trades and about a 70% loss on long trades. Okay, so that seems to be a very bad business model. Okay, and so if you look at the equity, there's a very beautiful decrease, a very beautiful negative equity curve, very stable, very beautiful equity curve. And so I thought to myself, wow, I mean, what are the parameters of this trade? The parameters of this trade were, in fact, risk to reward of 1 to 1, meaning I'm going to risk 1 to gain 1. Okay, and if that is giving this, if I'm expecting price to continue, wouldn't it give this if I flip the trades, the trade operation? So instead of selling, we're buying, and instead of buying, we're selling. And so now I am testing this hypothesis, and I put it on the same time frame. I swapped the algo, so now the algo is buying when it was previously selling and selling where it was previously buying. And we'll see how that turns out. But I just need data to help change my belief system about how I think the market works. And I think that in a couple of weeks, we should have a little bit of data, and I will share this with you. Okay, but use the software to backtest. You can use a configuration that I have, or you can get creative. You can also even say, for example, well, I think that if price manages to move, let's say 5 times in 3 periods, I mean, that's a huge price inefficiency that's going to be left. So if we zoom out, we look at those, and here you can see price went so far and it snapped back. Price went so far, it did not snap back. Price went so far, we snapped back. So far, snapped back. So already there you can see that on this one here that we've had a loss, winner, loss, winner, winner. And so they just need more data. as you can see. But you can get quite creative. You could also incorporate other parameters where you could say, for example, if price does this and it is the end of the London session, is price likely to move back into the mean at the end of the London session, or the end of the New York session, or the London lunch session, which is a very gifted trader I know, Maria Delgado, trades. She trades the London London lunch session, I suppose you could call it a session, a micro session, where if the pound is rallying during the morning and it becomes lunchtime in London, prices will often fade back in. So she was trading this strategy. And so this would be a perfect strategy to assess, considering what we've discussed already today. Okay, good. I'm going to leave it at that. I've been rambling for half an hour, but if you have any questions, let me know. If you have any ideas, please share them with me in the comments below. And I'll leave it at that. Thanks for watching.